So we'll come back to this slideshow and go straight to the charts here. And I just want to talk to you about the first thing I actually wanted to talk to you about in terms of this process is you need to identify the level, what we call a power zone, a strong horizontal level, which could potentially stop price action going up or going down, a key barrier, suffices to say. And then what we do is look for a price action reversal, and then we look for the pullback. And guess what? We trade all three of these. This strategy can work on any asset class, whether it's a currency pair, a stock, a commodity. I'll show you examples of stocks, and we're watching a few stocks at the moment as well as currency pairs. I mean, this is fully universal, so don't worry. It's not just something you can trade on like cable or euro dollar or anything like that. It's 100% universal. So let's talk about a couple of past examples, and then I'll go and show you my watch list of what is happening in the future. Because, showing you a hindsight example is all very well and good, but it's always very important when it comes to trading to be in the present as well and to be forward-looking. I mean, I can talk to you for weeks about hindsight trades, but will it benefit you? Well, maybe, but it's very important to be in the eye of the storm and in the present and be in sync with what's happening in the market right now. So without further ado, I'm going to talk to you about this key level of resistance this is pound versus the British pound versus the New Zealand dollar. And we've got a decent horizontal level here at around number. So given this correlation of two factors, we can reasonably say that this is potentially a very good barrier in the way, obscuring price action from going any further up. So what we're going to do is simply anticipate price action turning around at this point. It's a key level of resistance or key ceiling in the way. So what we're going to do is simply place a sell order here, and most aggressive traders out there who want to get in two moves pretty much early, then this is what they'll be doing. So we'll place order 1 here, 1% of our trading account over how much we typically risk, and we'll have our stop loss 50 to 100 pips above the level. If you want to be tight, but in this case, I say 150 is just fine. So our stop is just around here, and we get triggered into the trade. There we go, triggered into trade number 1, and then we have our price action base set up here. So we're already in off the back of the level here. So as we've got a bearish pin bar reversal, we can move trade 1 to break even. And now, because we've got our bearish pin bar reversal with bearish reversal divergence as well in the RSI, showing that the strength with the bars is getting less and less, what we can do is we can place our order for our second trade just below the low of this bearish pin bar reversal with our stop loss above the high. Remember, we've got our first trade still running, which is at break even. Fantastic. So now what we can do is add to this position and just have an extra 1% or 2%, however much you risk per trade exposed. And there we go. We're triggered into the trade, and there we go. We can just simply write this down, move our stop loss to break even after a second seller bar, and then just anticipate this as a trade which is going to take us to the bottom of the range. If you're somebody who would rather have a higher probability of success or winning trade, but are happy to obviously accept a smaller reward for this, then I would invite you to take profit for both orders you have or both trades you have on this currency pair halfway to the bottom of the range, like so. Okay, but if you're someone who would rather go for a lower probability and anticipate a higher reward by targeting the lower quartile of this range, then of course, by all means, go for it. So it's very personal, this thing, what kind of a trader you are. I'll personally scale out, to be honest with you, and take half my profits off the table halfway down to the bottom of the range here and leave the remaining position going. That's called having the best of both worlds, which is absolutely no bad thing. And, this is just an example of range trades really kind of doing nicely. So if you can imagine, if you'd risk 2% on both trades, your account will be up like a massive amount off the back of this trade. And, this was a very, very simple setup. And just to recap, it was just a simple case of identifying what we call a power zone or a level of strong resistance, place our order on the level of resistance for a short, having price action base reversal off this level, moving our first trade to break even, and then placing a second order. In most cases, with these setups, we get a pullback to the 0.618 Fibonacci retracement. We didn't get it this time round, but we took profit halfway down the range and left the remaining position running to the bottom. Some of our clients actually placed the order and completely forgot about it. And ironically, they actually did better than most people. But yeah, you can see that even though it took a while to hit profit target, this is all you really need for the year. I mean, people who took risk 2% on both trades would have made between 20 and 30% return on their trading account if they took it all the way to the bottom of the range here. And I will say as well, to the advantage here is if it was if you have a trading account with a broker, which is obviously direct market access, then you can benefit from the interest rate differentials. So in Britain at the time, this was back in 2012. Don't worry, there are more recent trade examples, plenty more. But back in 2012, sure enough, there was a big difference between the interest rates in Britain and New Zealand. I believe, well, currently now in New Zealand, the interest rate is 3.5%. Great Britain, it's, well, 0.25, I think. Either way, if we're going short on the pound versus the Kiwi dollar, or the New Zealand dollar, which has a higher interest rate, then that means that we are benefiting from buying the Kiwi, or the New Zealand dollar, and selling the British pound. So it means that we can benefit every night from the difference or the interest rate differentials and be added a small amount in our brokerage account. Whereas if it was the other way around, we would be losing money. Anyway, suffice to say, a lot has happened in the market since 2012. I just want to talk to you about a more recent trade, which some of our clients had the initiative to take quite recently. Let me go back to now. Here we go. It's at level 2,100 again. You know, so what happens in the market? What has happened before tends to repeat itself. So you can see here that people have the foresight of getting and the if you forgive the expression, the testicular fortitude of putting their orders in on this level here in anticipation of a whiplash reaction. Bulls taking this market all the way up to this 1.200, had their stop loss 150 pips away, and before going down, and they got filled in a day of volatility, which is absolutely fine. So they would have been triggered into the trade on the level here, like so, and then they'll be waiting for a price action base setup. Did they get it? Well, no, they didn't get a bearish pin bar reversal. They got an inside seller bar, but that's not really on the radar in terms of our strategies. And then what happened thereafter? They're nicely in profit, by the way, very nicely in profit. Some took profit halfway on this intermediate range here, but others who had slightly more, dare I say, well, wanted to go for that all-out kind of win, what they were waiting for was a retracement. Typically what happens when we get a key reversal off a level is we get the initial move like we had earlier in, September, late September. Then we had the retracement, and this typically happens at the 0.618 Fibonacci retracement level. And exactly true to form, this is what happened this time round. So when we get a key reversal, even if we don't get a price action to confirm it, as long as we just get the move off the level, get the 0.618 Fibonacci retracement, this would give people who are already short on the level the opportunity to once again add to their position short. So what they'll do is, thanks to the fact we've got a bearish pin bar reversal off the 0.618, they'll place their order just below the low here, a minus spread, minus an extra pip with their stop loss above the high, plus whatever the spread is, plus that additional pip, and take it to wherever they see fit, whether it be the previous swing low or whether it be this level here. I'll just redraw this line. There we go. For a higher probability lower order outcome, or if they're just going to anticipate a long-term short all the way to the bottom here. It's entirely up to them, and whatever works for their psychology. Everyone's different.